So the stock market's been moving up and down like crazy lately. Stocks like MicroStrategy are going up and down sometimes 10 to 15% per day. I did just make a play on MicroStrategy. So let's break down everything that's going on in the stock market right now. We're going to go through my Alpha Report, 100% free. Link is below to get that. Alpha Report 16 is the one that we're going to go through right now. We're going to go through what interest rates are doing. We're going to go through the strength of the economy. We're going to go through what actually moves the price of stocks. We're going to go through my watch list, my favorite trades, how my account's doing, some trades I recently closed out. So starting out, going from the top, we're going to hit on this tweet here super quick. So I'm going to be honest with you guys. Most people should not even own stocks, and most people should not even do stock options. Number one, because most people don't have their emotions in check when the market either goes up or the market goes down. I talk to so many people where it's like, oh, this stock is pumping, oh, MicroStrategy is pumping, whatever the stock might be, and they're like, dude, I'm going to keep buying into it. It's going to keep going higher. It's never going to go down. And I'm like, dude, this stuff has been going straight up. It's disconnected from the fundamentals. It's very likely that a dip will happen, and that's why most people, they buy high and they sell low. They lose money. I don't do that. I like to buy low and sell high. Of course, that's what most people want to do, but most people just let their emotions get the best of them. And just think of it like this. If you're going to go buy a car, maybe the car is $50,000 today, and then the dealership calls you up tomorrow and says, hey, the car's $40,000 today. Do you want to buy it? You're probably going to be like, is it the same car? Did it get crashed? Is there any problems with it? And if it's the same exact car as yesterday, but it's on sale today, you're probably going to want to go buy that car. But when it goes to the stock market, when stocks happen to go down, people just panic and they want to sell everything, but you're selling things when they're actually cheaper and they're safer to get into. So don't get in that habit. Get in the habit of having a level head, understand what you're investing in at the valuation level that you're investing at, and you should be good. So going through the Fear Greed Index for today, it's 65 today. You can see right here, we're slightly into the greedy category. And I feel like this is pretty important to look at because you want to be greedy when other people are fearful. So when there's people fearful over here, if the needle was over here, this is the time to be greedy. And when people are greedy, this is when you want to be fearful. That quote is from Warren Buffett, and I do stand on those principles. I'm not saying right now the stock market is a bubble or we're going to crash, but I'm just saying you're paying like a little bit more than MSRP. Maybe that car is worth $50,000, but now you're paying like $55,000. It's maybe like 10% overvalued. But here's the deal. Even if the stock market were to go down by 10% back to intrinsic value, that doesn't mean it's going to go down just to intrinsic value. It could actually go below intrinsic value and go into this fear category right here. So maybe if from here to here is a 10% drop, but maybe from here to here is another 20% drop, the market could go down 30% or maybe up 10%. You know, it's hard to say exactly what it's going to do, but it's just more likely that the market is probably going to take a breather in the next year or two versus going a lot higher. That is my opinion. I could be wrong. And just keep in mind, I have a couple $1,000,000 in the stock market right now, and it's oriented for the stock market to go up. So if the market goes up, I make a bunch of money. If the market goes down, guess what? I'm going to buy the dip. I'm going to get things at a discount, and I will use stock options to magnify my returns. So going down to the $1,000,000 lesson super quick, and then we're going to get into my trades. We're going to get into what's going on in the stock market. And this is really going to be divisive among a lot of people right here. So I can make any chart look bullish or bearish at any given time. So don't get sucked into charts just because they're sexy, because they're cool to look at, because it's easy to put your moving average on there or your Fibonacci, whatever it may be. The number one thing that matters for what a stock is going to do in the long run is what the earnings of those companies do. If their earnings go up by 20%, in theory, the stock should go up by roughly 20% too. I know there's a bunch of other factors that go into that, but at the end of the day, just think about it very simply. If you're going to go buy a landscaping company, you're not going to care about what their chart looks like. You're going to say, if I buy this company for $1,000,000, how much do you profit? If you profit $100,000 per year, it's going to take me 10 years to get my initial investment back. That is what a PE ratio is. That's assuming that the earnings don't grow going into the future. But just know what you're buying. Don't worry too much about the charts. There is value in them, but I don't really put a crap ton of value on it. So interest rates are like gravity on the stock market. Just recently this week, we got PCE, which is personal consumption expenditures. So basically what PCE means is that is how much money people and households are spending on items that they buy. So in my opinion, this is a very strong sign of the economic strength of America. If PCE was low, that indicates that there's low demand in the economy and there's low demand to buy things, which means that people probably don't have money to go spend money on stuff. So that'll probably lower inflation, and at the same time, that's going to trigger the Fed to want to go cut interest rates even more and even do it faster because they want to try to respur the economy. But here's the deal with that. Everybody out there wants to have interest rates go down, But if interest rates are going down because PCE is low, because the economy is not really doing much, I promise you that's going to be way worse than just having a strong economy with like kind of high interest rates. We want to have a strong economy. We don't want to have a crap economy where the stock market falls 40, 50%, but great, we have 0% interest rates. We don't want to be in that situation right there. I mean, of course, I have a plan for all situations. If the market were to take a dip, I'm just going to buy the dip, so it's going to work out for me. But as a whole, we want PCE to be roughly around 2 to 3%. We just got a report from October where it's 2.3%. So we're in a pretty good range right there. And just to hit back on PCE real quick, if PCE was high, that indicates that the economy is strong, people have money, people want to buy things. But the problem with that is that the Fed is probably going to say the economy is strong, we're worried about inflation potentially because PCE is going higher, people are willing to pay a higher price for things, so we're going to keep interest rates higher for longer. A lot of investors are going to say, I don't like that, I don't want interest rates higher for longer. But in my opinion, like I just said, I would much rather have rates higher for longer versus having rates get cut to zero, but then we're in a recession. So keep that in mind when you look at interest rates, and also think about this right here. Interest rates, like I just said on the title right here, interest rates are gravity on the stock market. They are everything. Warren Buffett said that interest rates are gravity on the stock market. And the reason why is because it all comes down to the valuations. It all comes down to money wants to find the best risk-adjusted return. If you would assume that the S&P 500 does 10% per year, every year going into the future, I get it that that's an average annualized return for the last 50 years, but let's just say to keep it simple, 10% per year every single year. Great. But a bond rate now is roughly 4%. So do you want to get a guaranteed rate of return in a bond for 4%? Or do you want to go do a risky 10% in the stock market? You know, the stock market could go up 40% one year, down 40% one year, it bounces all around. Do you want to have to stomach those volatility swings? Some people will say no, some people will say yes. So when a bond is 4%, but the stock market's 10%, there is competition. People might say, well, I don't want to deal with the volatility of the market, so I'm going to go into this bond where it's guaranteed. But think about it like this. If a bond was 9% and the stock market is assumed to do 10%, is really anybody going to put their money in the stock market and risk it for that extra 1%? Honestly, not that many people. And what's going to happen in that situation is stock market valuations are going to go down because there's less demand to put your money into the stock market. People are going to put their money into the bond. And then think about it like this. If a bond goes down to 2% and the stock market is 10%, not many people are going to waste their time with a bond where you're going to get these interest rate payments that you have to pay taxes on. You know, after taxes and inflation, that bond is probably really not even doing anything. You're probably losing money on the bond, to be honest with you. So interest rates are gravity on the stock market. Rates affect bonds, they affect CDs. All of that stuff matters. So think about that when it comes to inflation, when it comes to CPI, when it comes to PCE. All of this stuff matters a lot more than you think because it all comes down to what are interest rates doing because they are gravity on the stock market. Now going down to the market valuation and what actually moves the price of stocks in the long run. So as you guys know, I feel like the market's a little bit overvalued. I've been saying this for the last couple months. I say this in all my YouTube videos. I say it in Discord. I feel like we're a little bit overvalued. I don't think we're in a bubble, but like the forward PE ratio on the NASDAQ right now is roughly like 32. The NASDAQ PE ratio in 1999 was over 200, so we're nowhere near those valuation levels as then, but I do feel like we're a little bit lofty. And another thing to think about, I don't put a crazy amount of weight on this, but Warren Buffett has so much cash on the sidelines, maybe he's going to buy an entire company outright, maybe he just sees the stock market as super overvalued. I did run Apple through my intrinsic value calculator, you could get it below for free, and it does appear to be way overvalued in my opinion, and maybe that's why he's selling a bunch of Apple. So right now I do think we're a little bit overvalued. I'm not saying we're a bubble, but just be careful out there. And if you do have capital on the sidelines, what should you do? And this is what I am personally doing right now too. So I will continue to dollar cost average in the VOO and triple Q. I will only buy individual companies if I'm getting a good price, if I feel like I'm buying below intrinsic value. And I will only use options to magnify my returns on companies that I have a very high margin of safety on. Options are only used to magnify my returns. So if I feel like SMCI or Google or whatever company is trading below intrinsic value right now, maybe I'll go buy shares of that company, but maybe I'll also buy calls or maybe I will sell puts. I like to sell puts more than I buy calls because when you sell puts, you have a lot more flexibility. The stock could go up, it could go flat, it could go down all the way to the strike price, and you still make the full premium amount. and it could even go below your strike price, and you could still make money up to the amount of premium that you receive per share. I'll link a video at the end of this video. It'll break down how I trade stock options, and this is my watch list. I'm not going to read all my price targets to you right here, but this is what my price targets are for end of year 2025. My favorite new trades, I did add a couple here on the bottom. So MSTR, I am selling calls on. I'm doing a 1 week duration, and I'm doing the strike $90 out of the money. I know it sounds crazy to go $90 out of the money, but I promise you MSTR moves like crazy, and I'm picking up some really solid premiums on a 1 week basis. So I will continue to sell calls on MSTR. You know, obviously MSTR is tied very closely to the price of Bitcoin. So if Bitcoin happens to moon, it will get tight right here. It will be close to the strike. But if Bitcoin goes flat or goes down, these are going to expire worthless. We collect the premiums and we just roll it on to the next one. SMCI, I still like it. Google, Palantir, Nvidia, all these trades right here I still like. If they're on here, I like them. And if you want to get my alerts and my exact trades in real time, check out my Discord, links below for that. And going through my trading account, as you guys saw, we're at $899,000. Here's a couple trades that I did just recently close out. SMCI, I did a quick little day trade, $392. Triple Q, I closed out this one. I made $10,500. Another Triple Q one, $8,000. So this week alone, I booked roughly $19,000 in profits. So looking pretty good for the week. And my rate of return since 2023 is 64% annualized. This is my blue line right here. And you can see right here, I have a little bit more volatility versus what the S&P 500 and the NASDAQ does. S&P 500 is the orange line. NASDAQ is the black line right here. But volatility is not risk to me. Volatility is opportunity. Look at the start location, look at the end location. This is only a 2-year period right here. I'll put a 5-year one on here for the next alpha report, and you'll see where I started and how much higher I ended versus what the S&P 500 and the NASDAQ did. And keep in mind, this is not me sending money to this account. This is my true return on investment. So, hope you guys liked out this video right here. And don't forget to check out all my links below, my stock options course, my Discord. I have a free stock market blueprint, free intrinsic value calculator. Check all that stuff out, guys, and I'll see you in the next one.